Hi, everyone. For anyone that doesn't know me, my name is Steve Vlasic, and I'm a partner at Richey May for our alternative investments practice. In case you don't know who Richey May is, we're a CPA firm that specializes in alternative investments, providing audit and tax services to over 1,000 different fund structures. As a CPA firm, we always try to add value for our clients, friends in the industry. When I speak with new fund launches, as well as existing funds, the topic that almost always comes up is capital raising and how to attract investors. So as part of our capital education series, and in order for us to provide some value on this topic, we have decided to team up with our good friends, Cap Intro Solutions, who will be discussing tips on raising capital in the current market landscape, as well as the different offerings that they provide. So at this point, I'm going to hand it off to Bob Marietta and Dan Lancellotti, who I'm sure will add lots of value for your marketing efforts. Thanks, guys.
Good afternoon, everyone. Thanks for joining us. We'd like to thank our friends at Richey May, especially Steve Vlasic, for asking us to present to you today, and Gabrielle Munson, who coordinated this entire production. And we'd like to thank you all for joining us today. My name is Bob Marietta. I'm the head of sales at Cap Intro Solutions. We are an outsourced capital introduction provider, helping managers in the alternative investment space. Personally, I've been in this industry for over 35 years, worked at some investment management firms, and primarily have been in prime brokerage with UBS, Cantor Fitzgerald, and TradeStation. Today, we are joined by Dan Lancellotti, who started the firm, Cap Intro Solutions, in 2017 after having been head of Citigroup's global Cap Intro team. Dan started that team in 2001 and built it into a global organization of 20 plus by the time he left in 2009. So Dan's been at this Cap Intro game for over 20 years now. And I think we both share the thought that this period we are in now in these markets is one of the most challenging of our careers outside of the 2008 global credit crisis. At that point in time, Cap Intro almost ceased to exist. This time around, we are actually seeing an increase in demand from our investor base for hedge funds. Now, it's not a tsunami, but it is noticeable. So we're going to take the next 30 minutes or so to make certain you've prepped correctly and are ready to take advantage of the environment. Then we'll have a couple of minutes toward the end to answer some questions that have come in before the session and during. Everyone has a plan until they get punched in the mouth. Right? That's a famous quote. I'm sure you've all heard it from Mike Tyson. And this slide sets the tone for how we think about the current environment. We want to make certain that we are Mike Tyson in this picture. He is the guy throwing the punch. As everybody know who the opponent is here. If you guessed Trevor Berbick, you are correct. And what we want to do is make sure as a manager, you're not Trevor Berbick trying 1, 2, 3 times to get up from the canvas. I'm sure all of you know this slide all too well. This is performance from the 3 major indices over 2022. It's not a very pretty picture, especially if you're the black line, which is the NASDAQ. It was a tough environment, but remember that investors' attitude is that hedge funds make money when the market's going down as well as when it goes up. Short side alpha is almost a universal request from our hedge fund investors. At this point, let me turn it over to Dan to walk you through our thoughts on how to best deal with this situation.
Thanks, Bob. When I went looking for this quote, I thought it was attributed to Napoleon, and I actually had no idea who Seneca was, and truth be told, I still don't have any idea of who he is. But funny enough, there actually turns out to be 2 Senecas, Seneca the younger, got the quote, and Seneca the older, who guess was dead by the time Seneca the younger said this. Regardless of who said it, it is indeed very much true that our industry, and many times the manager ends up with the allocation is thought to have been lucky by those he won the mandate from. I've seen many a tear sheet that could also be overlaid on one another. They look so similar. Same AUM, same track record, same length of time and business. So why does one win the mandate over the other? Oftentimes, it's exactly Seneca's quote. It's the manager that is more prepared that is the winner in terms of the allocation. This preparedness that managers need to possess, starts from the time that the manager opens the fund. not from the time you're ready to go market, but from the time you open the fund. And there are a myriad of pieces to start from the moment you start the fund that we're going to go through today in order to make certain that you're well prepared. As Seneca mentioned, this preparation needs to be done by all funds, regardless of size or length of track record. The majority of this presentation is going to be on the prep. I'm not going to cover all of the boxes you'll see on the following slides. There will actually end up being 4 columns in total here. We don't have time to go through each one of them in detail, but at the end of the day, we are more than happy to go through them in detail with you if you want to give us a call. The first one I want to highlight here is the one about being appropriately staffed. So now no investor is going to allocate to a fund manager who says, well, I'll hire the staff as I can afford it. It just doesn't work that way. And it's because basically teams are difficult to put together. Investors want to make certain that your team is going to function as a coherent unit before they start to allocate. And this can be even with people that you know well, the box that has gotten the no name, but the research analyst from big investment bank. That at the end of the day, even if you know that person, isn't going to really fly with investors. Many teams do not work smoothly as an operating unit, even if you know these people. And remember, a majority of small businesses fail. And yes, your fund is a small business. So you've got to treat it that way. That doesn't mean you have to overspend. We all understand the constraints of budgets. And what that means is that you have to really be clever in making your team look bigger than it is for the money that you can actually spend on it. And so how can you do that? Well, there are a couple of little tricks that we've learned over our time in the business. One is using an advisory board. If you can figure out how to put several people on an advisory board that you know and trust and feel that they can add knowledge to your firm. This is an unpaid position, but lots of people like to be thought of as valued participants, and it puts another page in your presentation deck to talk about the quality of your advisory board. Pick advisors that have gravitas in different functional areas. So for instance, if you're not so great at sales, put a sales guy on the team. If you're not so great with risk management, have somebody who has been in risk management / compliance as part of the team. And they don't necessarily have to have their day jobs be in compliance or sales, but somebody who's knows the ropes and has done the job in the past would be very useful. Another box I'd like to cover is the box of your target marketplace. And especially as you grow from being a small manager into a larger manager, you're going to face a transition as to who your target marketplace is. And making certain that you understand how you're going to make this transition when you first start is critically important. The number of managers who have gotten stuck between having a more retail philosophy to their management style find it very difficult to transition to being a larger, bigger manager, simply because they're talking to a different set of people. That set, the institutional client base is going to have different questions, different understanding of what you're trying to do than the retail marketplace. So understanding what your audience knows about your strategy is critical in making a very learned presentation. And when you're dealing with retail customers, education takes time. At the end of the day, you may not realize just how long the sales process can be to friends and family, and then to outside retail people, because they won't understand the strategy, and you're going to have to do education. And so subsequently, one of the other boxes I'd like to talk about is your operating capital box, making certain that you've got enough operating capital for at least 3 years in business without substantive income, because it could take that long to get to the point where you are profitable, especially if you're in the retail target marketplace for that time. If you've got a business plan, terrific, but many of the funds that we deal with don't have business plans, don't have financials put on paper. The institutional businesses that you may be trying to get money from will definitely be asking to see what your financials look like, and making certain that they are legitimate and well thought out is of critical importance. So moving on now to column number 2, is something that often goes overlooked. When I'm talking about the financials, it's a good case study. You need to keep these things up to date. You need to continuously assess where you are and how you're doing. Remember the advisory board I just mentioned. Lean on them to help you with these self-assessments. Are you hitting your marks? Are you doing what you said you would do to the investors you've currently got and to the prospects you're still pitching to? You do this with your portfolio on a daily basis. I'm sure that everybody on the call obsesses about the portfolio and how the portfolio is doing. Take some time to do it with your business, and step back and make certain that everything business-wise is shipshape. And when you come to assessing your strengths and weaknesses as both a manager from a portfolio perspective and a manager from a business perspective, make sure that you're honest with yourself, because any strength or weakness will definitely be uncovered by the investors and that are more institutional in nature. And again, a lot of times, when you're dealing with the friends and family round, you're not so much thinking about this, and then you find yourself sort of caught between a rock and a hard place trying to make that transition. We've had many situations where managers who haven't really succeeded with their strategy as initially they set out to implement, transition. So if you find that you're having trouble on the short side, many a manager has changed their focus and started focusing on the longer side, and instead of being market neutral, moving off a little bit of market neutral and a little bit more towards long bias. Now, obviously, these are changes that need to be communicated and implemented well in advance of actually doing it, but can be very beneficial. We had a client who, quite frankly, really suffered on the short side and did not know how to manage a short book. Could pick a couple of really good shorts, but wanted to be more of a market neutral fund, and that incorporated having a lot of shorts, and that it just didn't really work for them. And now the fund has been in business for 10 years and has done really well, but about 5 or 6 years ago, transitioned more to a long bias. Still have 1 or 2 shorts, but have moved away from the market neutral posture and have done exceedingly well, have doubled their assets since they did that. So at the end of the day, don't be scared about figuring out exactly where your strengths and weaknesses lie as you're doing it, because quite frankly, there's no chance that you've got to have a dry run of running a fund and then really starting the fund in earnest. So it is expected to a degree that you're going to learn by doing. As long as your documents and materials are consistent and well thought out and move on from each other, so that your 30-second elevator pitch dovetails into your one pager, which dovetails into your deck, your presentation deck, and then that dovetails or is at least consistent with everything that's in your DDQ, then you'll be in good shape. We spend a lot of time with clients on these documents, making certain that hierarchy exists. It doesn't necessarily mean you have to start with the 30-second elevator pitch. Some people prefer to start with more of the bigger document because they like to whittle it down instead of building it up, and that's a personal preference. But at the end, they've got to make certain that they are consistent and build upon each other. We actually have a guide for managers who have yet to do a one-pager. We call it our tear sheet essentials. And while I won't go through everything that needs to be on this document, I will say one thing that is most important. If you are going to expand it to more than one page, make certain that all the pages that you utilize have no white space, because at the end of the day, if you're going to make it 3 pages or 2 pages, to have white space when you can be saying something that could be very meaningful to an investor or insightful as to how you manage the portfolio, you would be wasting that opportunity. We actually produce, as managers go through their self-assessments, a readiness report, which is shown here. The report, this is just a sample, that the top part of our report, that after 3 conversations with a manager we'll put together, and you'll notice that the very first box is not what your track record is. Most oftentimes everybody thinks it's performance that gets you sold. Well, certainly performance helps, but in times, especially like these, when performance can be challenging, for the investor to understand that the team is solid, it is operating as a unit, and that even if part of this team is outsourced, that there is uniformity in the mission and how the mission is being carried out. And that is really more important than the track record. And quite frankly, as you talk to customers and prospects in these challenging times, if you've had certain challenges to your performance, making certain that you emphasize how the whole fund has worked in unison and how the challenges are being addressed, and how the performance should track going forward, you'll be much better off. So the third column, that I want to talk about is peer performance. And again, in times like these, understanding who your peers are, picking the right benchmarks, and the proper communication protocol is critical to getting through times like this. if you are able to keep investors abreast, more than not, you will gain credibility and confidence in your management. And again, this is still a business where people are buying personalities, and they want to be confident in who is managing their money, that the manager is consistent and thoughtful in their approach. And regardless, this transcends what the market's doing. Obviously, hedge fund managers are supposed to be going up in all markets. We know that doesn't happen, but losing less in times like these is certainly something to be proud of. And communicating whatever the situation is consistently and regularly is paramount. Also, making certain that you are identifying with the right peer group, and that is reflected a lot of times in the benchmarks you choose. If you are working at raising money from a more retail, friends and family kind of audience, then certainly the S&P 500 is often the index of choice, because most retail investors will compare and contrast you to what their opportunity set is, and their opportunity set could very well be the S&P 500. However, when you're talking with a more institutional base, they're going to start to hone in on exactly what you're trying to do. And if you're a fixed income fund, they're going to start thinking about, how you compare to some of the aggregates that are out there, the Bloomberg Ags. And subsequently, you're going to want to transition away from the S&P 500 more to the Bloomberg Ag. And you can certainly put two indices on your charts to begin with, and actually educate some of your retail investors that, in the long run, it's better to be compared against a more specific index as opposed to a more generic market index like the S&P 500. So at the end of the day, understanding who your target marketplace is very important when putting your one pager together. The kinds of charts that you put, portfolio composition, volatility, anything else that you put on your one pager, you want to make certain is going to be additive to the conversation you're having with your audience, as opposed to really getting you off track and having to do too much explanation about what the table or the graph shows. Having some understanding of how you're doing in your peer group will certainly help as well. But remember, peer groups, if you take indices from like hedge fund research, those indexes are basically composed, what you're showing is the average. And so therefore, if you're beating the average, remember that you're beating the average, and you're not in the top decile potentially. What we're striving for is to be in the top quartile, top decile. And so I find that having the index line on the page can often be a mistake. So the last column I'm going to talk about is a column called technology. And technology is very important when we're talking about sales and marketing, because it is often overlooked, and it's often what wins the day with respects to communicating with your investors in a way that gives them the confidence that the firm, the fund, is well organized to be able to provide information on their account with a CRM, to provide information with their monthly letters, and be able to communicate those letters in a way that that you as the manager can understand who's looking at your letters or your monthly updates. If you don't have an email tracking system, you're really operating in the dark. It's like going back to cars without GPSs. You need the GPS to understand where the opportunity lies within the prospect base. And it's not cumbersome to use most of the time now. It's not expensive to use most of the time now. We do a lot of consulting on what CRMs, what email systems really are the best bang for the buck. That furthers down the line to data rooms, making certain that you have all of your salient documents in a data room, especially the ones that are necessary to close a transaction and to do due diligence for investors. Because once investors get into the due diligence phase, you really want to know that they're active and that they're looking at the documents in your data room, and making certain that all of this infrastructure is cohesive, that the CRM and the email system and the data room are all talking to each other and making certain that you can have the information at your fingertips without too much stress is critically important to your sales process, to making certain that your sales process is efficient and you're talking to the right investor at the right time, or quite frankly, that investors have gone dark on you, and trying to understand when that happened and why that might have happened can actually, especially when it comes to investors, save you from losing an account. If you understand that the account's in jeopardy and you make a phone call to reassure the investor that everything is going to be okay if performance has suffered in a debt market downturn like we have now. So given that you now have a strong foundation, we'll get to the second bullet point here on our slide, which is persist. We've prepared, now we need to persist. And honestly, this can be one of the more troubling aspects of sales and marketing campaign when times are like they are today, markets are like they are today. Staying in front of your investor, continuously communicating can be very challenging and can be very humbling. And we all get it. But it also allows the investor to ask questions and to understand and gain understanding where you sit in these markets, and gain confidence that you're doing the right thing and that you've got the wherewithal to weather the storm. And then subsequently, you will prosper and they will prosper. Again, going back, this is a business where confidence is paramount. And if you can build confidence in times of trouble, as we are facing, some of you are facing right now, or when you might face them independently because of something that's happening in your particular markets that was unforeseen, you will be able to get through. And with that, I'll turn it back over to Bob, who's been monitoring the question box.
Yes, Dan. So we've had a number of questions come in that I'll throw at you for your expertise. First question we received is, how do I stay compliant while reaching out to potential investors without having a strong pre-existing relationship?
Well, that's an excellent question, and one not a lot of managers actually think about, especially over the last few years, given the new rules and regulations which seemingly relax some of these requirements. Things like Reg CF and Reg A Plus are making people think that they don't have to worry about situations like this anymore. And one of the easiest ways around it would be to use us because we have those pre-existing relationships. But if you're hell-bent on doing it yourself, the best way to do it is to start the process very slowly. Cold calls are part of this business, and making a cold call can be difficult. But if you're not there really at that point to sell anything to the investor, it's more to open up a dialogue and to get the investor talking about what they're looking for in a manager and what they're looking for in a strategy, even though it might not be the strategy you're selling at the time. It's relationship building, and it helps get you past this substantive problem. It also gets to know whether they're going to be accredited and whether they're going to be eligible for them to invest in your fund. So the best way to do this is to set another call 2 weeks later to talk about something that might come up in the first call with respects to markets or their interest in a particular sector or whatever strategy, whatever have you, what they might be interested in, so that you can call them back. And that is a second phone call that really sort of cements your relationship with them. And then, after 30 days of the first call, you'll be good to go and call them back and solicit them for your specific fund. It's a process, but that, if done correctly, can really build trust and confidence with that particular prospect.
Okay, great. Well, the next question, something we hope doesn't happen to our managers, but inevitably it might, and it has. Everyone likes to attend these conferences and have their one-on-one meetings, and many of these conferences, you've got to plan in advance, and you've got to pay in advance, perhaps there's an early bird sign up and whatnot, and you could save a couple of bucks. So you go out maybe 6, 10, 12 months, sign up for a conference, and then, inevitably you may step in a landmine and have a terrible month. So the dilemma and the question really now, Dan, is I've had a bad month and I'm heading to a conference that I did pay a lot of money for. Should I back out even if I only get a partial refund? I mean, how do you handle a situation like that?
Well, you only get one chance to make a good impression. So this is sort of a tough one. As a cap intro team, we would most likely step away for a month or two to let your ship get righted. But conference dates are set in stone, as you point out, so you really don't have that luxury. Again, if you have the foundation set the way we've described in the earlier part of the presentation, you can really actually lead with your front foot, as Mike Tyson does. If the entire strategy in the world has gone through a tough time, then you can fall back on that again, but don't overdo it, because again, as I said, investors are expecting managers to go up even in difficult times, or at least not go down as much. If the issues were idiosyncratic, be prepared to debrief the investor that you meet with exactly what happened, where your process broke down a bit, and what you've done to modify that so that it won't happen again. That you've learned from your mistakes. You'll only make your mistakes once, and then how you plan on moving forward so that you can recapture that loss, and that this in fact may be a good opportunity for investors to consider an allocation, maybe not a full allocation as they would want to eventually work up to, but at least an allocation to see how you do recover and take advantage of the fact that you're going to bang off the bottom.
Okay, great. And we have time for one more question, and I apologize if there's any questions we don't have a chance to address today. I will be following up with anything that's come in through the chat. So you'll be hearing from me if your question wasn't asked today. But the last one I have for Dan is, how do you address not having enough AUM when you're talking with a larger investor?
Well, that's actually a pretty easy one. Most people wouldn't think that, and we didn't really touch on it in the presentation. But there are 3 ways. The first is be open to doing an SMA or a fund of one. Many bigger institutions won't invest into the pool vehicle anyway. They'll even want a fund of one or an SMA. And if you're doing something unique with your strategy, that makes it easier for cap intro teams or for yourself to introduce that to even the biggest of organizations, the pensions, endowments, and foundations. We talk to E&Fs all the time about small managers with unique approaches. And that the uniqueness can be with the strategy itself, or the way you do an equity long short strategy, or the types of things you consider and the securities you select. So it's important, again, to highlight your strength, be able to relate that in your documents, and be able to define that to even the biggest of investors. The second is to look for a best ideas fund, like West Tower. They are people who are looking for just the best of ideas, and will take one idea of yours and pay for it. And subsequently, that's the way they get to know you. And hopefully that leads to a bigger allocation in their pool to your pool vehicle down the road. And then finally, there's first loss. Now, don't react, negatively, as most people will, because first loss doesn't necessarily need all of your assets to be dedicated to the program. You can take a portion of your assets and put it in the first loss program, so that you're not putting all your eggs in one basket. And you don't have to do a traditional first loss program either. And what do I mean by that? Well, we're working with a couple of managers right now whose majority investors have actually stepped up to provide the cushion for the other investors. They're shouldering the first loss. And so that's a pretty interesting idea. I think one that you're going to hear more of and see more of in the future.
Dan, that's a great point. Cap Intro Solutions can be a great partner to your business because we speak to investors each and every day when we get the pulse of what's going on in the marketplace. We feel we can be a great partner to you and your business because we have boots on the ground in the investor community. Over time, especially during the pandemic, our business has evolved so that our offerings have actually changed to meet the needs of our clients, our alternative asset managers. We have a product and an offering that we think appeals to everyone. I'd love to talk to you more about it. My contact details are listed on the screen. Please feel free to reach me anytime you want, email, call me on the phone. I'm happy to discuss how we think we can help your business. With that, we're going to turn it back over to Steve Velasquez at Richey May. And we just want to say thanks very much to everyone who participated today, and especially Richey May, Steve, and Gabrielle, who did so much to help get this presentation put together for us.